Wait, $100 can really turn into $1,000 monthly? That's impossible. I get it. When I first heard about dividend investing, I thought it was just for the rich. But here's the exciting truth. Even a small start can grow into something big. In this video, we're breaking down how you can build a dividend portfolio starting with just $100. You'll learn the exact steps to turn your spare change into a steady stream of passive income. Ready to see how your money can work for you? The $100 starting line, your first step to financial freedom. Imagine this. You're standing there, a crisp $100 bill in your hand. You're wondering if it's enough to start investing. Maybe you've heard that you need thousands to get started, or that investing is only for people with fancy suits and Wall Street knowledge. But here's the thing. That $100 bill could be your ticket to financial freedom. Yes, really. Let's talk about Kara. 5 years ago, she was in your shoes. She had a spare $100 and a dream of building wealth, but wasn't sure where to start. Kara decided to take a leap of faith and invest that $100. But she didn't stop there. Every month, she added a little more to her investment account, sometimes $50, sometimes $100, whatever she could spare. Now you might be thinking, okay, but how can such a small amount make any real difference? That's where the magic of compound interest and dividend reinvestment comes in. When you invest in dividend-paying stocks or funds, you're not just buying a piece of a company. You're buying a slice of their profits too. Here's how it works. Let's say you buy shares in a company that pays a 3% dividend yield. That means for every $100 you invest, you'll get $3 back in dividends each year. Now, $3 might not sound like much, but here's where it gets interesting. Instead of pocketing that $3, you can reinvest it. That means using that money to buy more shares, which will then earn you more dividends. It's like a snowball effect. Your money starts working for you, making more money. Kara understood this concept and set up her account for automatic dividend reinvestment. Every time she received dividends, they were immediately used to buy more shares. This way, her account grew not just from her monthly contributions, but from these reinvested dividends too. But Kara's strategy wasn't just about reinvesting dividends. She also understood a key principle. Time in the market beats timing the market. Instead of trying to guess the perfect moment to buy or sell, Kara focused on consistently adding to her investments over time. Some months, stock prices were up. Other months, they were down. But by investing regularly, Kara was able to take advantage of dollar-cost averaging, buying more shares when prices were low and fewer when prices were high. Now, 5 years later, Kara's initial $100 investment, combined with her monthly contributions and reinvested dividends, has grown into a $5,000 portfolio. That's right. From a humble $100 start to $5,000 in just 5 years. And the best part? Her portfolio is now generating its own income through dividends, which she continues to reinvest. Kara's story shows us that you don't need a fortune to start building wealth. What you need is consistency and patience. It's not about making huge, dramatic moves. It's about taking small, steady steps in the right direction. Think about it this way. If you wait until you have enough money to start investing, you might be waiting forever. There's always another expense, another bill, another reason to put it off. But by starting with what you have, even if it's just $100, you're putting yourself on the path to financial freedom. Remember, every big investor started somewhere. Warren Buffett, one of the world's most famous investors, bought his first stock at 11 years old. He didn't start with millions. He started small and built his wealth over time. So let's recap what we've learned from Kara's journey. 1. You can start investing with just $100. 2. Consistent, regular investments add up over time. 3. Reinvesting dividends can accelerate your portfolio growth. 4. Time in the market is more important than timing the market. 5. Patience and consistency are key to building wealth. Now I know what you might be thinking. This all sounds great, but Kara's story happened in the past. What about now? What about the future? It's a fair question. The truth is, we can't predict exactly what the market will do in the future. There will be ups and downs. That's just part of investing. But here's what we do know. Over the long term, the stock market has historically trended upwards. Yes, there are dips and crashes along the way. But if you zoom out and look at the big picture, the trend is clear. This is why starting early and staying invested for the long term is so powerful. Of course, it's important to remember that investing does come with risks. The value of your investments can go down as well as up, and you might get back less than you put in. That's why it's crucial to do your research, diversify your investments, and never invest more than you can afford to lose. Demystifying dividends, your ticket to passive income. Now that we've covered the basics, let's talk about making your money work while you sleep. Ever wondered how some people seem to earn income without lifting a finger? It's not magic, it's dividends. And they might just be your ticket to financial freedom. Think of dividends as a thank you check from companies you invest in. When you buy shares of a company, you become a part owner. If that company does well and decides to share its profits, they'll send you a little something extra. That's your dividend. Pretty cool, right? But here's where it gets interesting. How do you know which companies will pay you and how much? That's where understanding dividend yield comes in handy. Don't worry, it's not as complicated as it sounds. Dividend yield is just a way to measure how much a company pays out in dividends each year compared to its stock price. Let's break it down with a simple example. Imagine your friend borrowed $100 from you, and they agree to pay you $4 a year for using it. That $4 is like your dividend, and the 4%, 4 divided by 100, is your yield. Easy, right? Now you might be thinking, great, I'll just look for the highest yield I can find. But hold on a second. While a high yield can be tempting, it's not always the best choice. Sometimes a really high yield can be a red flag that a company might be in trouble. It's like if your friend suddenly offered to pay you $20 a year for that $100 loan. Sounds great, but you might wonder if they're desperate for cash. Understanding dividend yield helps you compare different investments. It's like having a special tool in your financial toolbox. For example, let's look at some real-world numbers. Did you know that the average dividend yield for the basic materials sector is 4.92%? That's pretty impressive. But if we zoom in on the S&P 500, a group of 500 large U.S. companies, the average yield for basic material stocks there is 2.5%. See how knowing these numbers can help you set realistic expectations? Here's another interesting tidbit. Different sectors of the economy tend to have different dividend yields. The utility sector, for instance, has a high average dividend yield of 3.96%. On the flip side, the industrial goods industry has a lower average yield of 1.76%. This doesn't mean one is necessarily better than the other, it's just how different industries tend to operate. Now let's talk about something really cool. Dividend aristocrats. These are like the royalty of the dividend world. They're companies that have increased their dividends for at least 25 consecutive years. That's a quarter of a century of giving more and more back to their shareholders. Some examples include household names like Procter & Gamble, Coca-Cola, and Johnson & Johnson. These companies have shown a strong commitment to returning value to their shareholders over a long period. But remember, dividends aren't guaranteed. They're typically decided by a company's board of directors and are paid out of the company's earnings. Companies have choices to make with their profits. They might reinvest in the business, pay down debt, or distribute dividends to shareholders. When a company consistently pays dividends, it can be a good sign of their financial health and their commitment to shareholders like you. Let's look at some specific examples to bring this to life. In the consumer goods sector, which has an average dividend yield of 2.22%, companies like Altria, Kimberly-Clark, and PepsiCo have increased their dividends every year for the last 25 years. That's pretty impressive consistency. Or take the healthcare sector with an average yield of 2.28%. While it's not known for super high yields, it has some really reliable dividend payers. Johnson & Johnson and Abbott, for instance, have been increasing their dividends for 25 consecutive years. Now, you might be wondering about the highest yielding sectors. Well, the oil and gas industry, particularly in equipment and services and refining and marketing, often has yields exceeding 5%. And in the consumer goods sector, believe it or not, the cigarette industry is known for its high yields. But remember, higher yield doesn't always mean better investment. It's about finding the right balance for your goals and risk tolerance. Some companies, like ExxonMobil and Sherwin-Williams, have proven their dividend reliability by increasing their payouts for over 25 years, even if their yields aren't the highest. ETFs, your shortcut to a diverse dividend portfolio. Let's talk about a game changer in the world of dividend investing, ETFs. Imagine being able to invest in hundreds of dividend-paying companies with just one purchase. Sounds too good to be true, right? Well, that's the magic of exchange-traded funds, or ETFs for short. Think of ETFs as a basket filled with many different stocks. Instead of picking individual apples at the grocery store, you're grabbing a pre-made fruit salad. It's convenient, diverse, and takes a lot of the guesswork out of investing. But here's the thing, with so many ETFs out there, how do you choose the right one for your dividend strategy? Let's focus on two popular dividend ETFs that could be perfect for beginners: the Schwab US Dividend Equity ETHD and the Vanguard High Dividend Yield ETF, VYM. These funds are like the cool kids of the dividend world, and for good reason. First up, SCHD. This fund is a favorite among cost-conscious investors, and it's easy to see why. With an expense ratio of just 0.06%, it's like getting a designer handbag at a thrift store price. But low cost doesn't mean low quality. SCHD has been showing off with a dividend yield of 3.29% and a dividend growth rate of 13.74% over the past decade. That's like getting a raise and a bonus every year. Now let's chat about VYM. This Vanguard ETF is all about high-quality dividend-paying stocks. It's like the friend who always knows the best restaurants in town, reliable and consistent. VYM offers a dividend yield of about 3.0%, which is nothing to sneeze at. But why should you care about these ETFs? Well, here's where it gets exciting. By investing in SCHD or VYM, you're instantly spreading your money across a bunch of different companies. It's like having a piece of hundreds of dividend pies instead of just one or two. This diversification can help protect your investment if one company has a bad year. Think about it this way. If you put all your money into one stock and that company hits a rough patch, your investment takes a big hit. But with an ETF, you're spreading that risk across many companies. If one stumbles, the others can help keep your investment steady. This is especially great for beginners. Remember when you first learned to ride a bike? ETFs are like those training wheels. They give you stability while you're learning the ropes of investing. You get exposure to a wide range of dividend-paying stocks without having to research every single company yourself. It's a smart way to start building your dividend portfolio, even if you're starting with just $100. Now let's dig a little deeper into why sector selection matters when it comes to dividend ETFs. Different sectors of the economy tend to offer different dividend yields. For example, the financial sector has an average yield of about 4.17%, while the consumer goods sector averages around 2.22%. By choosing an ETF, you're getting exposure to various sectors, which can help balance out your returns. But wait, there's more. ETFs like SCHD and VYM don't just offer dividends. They also have the potential for capital appreciation. This means the value of your investment can grow over time on top of the dividends you're earning. It's like getting a slice of cake and finding out there's ice cream too. For those of you who love reliability and who doesn't, there's another ETF worth mentioning, the SPDR S&P Dividend ETF, SDY. This fund focuses on companies that have increased their dividends for at least 20 consecutive years. It's like the marathon runner of dividend ETFs, consistent and enduring. Now you might be wondering, can I really start building a diverse dividend portfolio with just $100? The answer is a resounding yes. With ETFs, you can buy a fraction of a share, meaning you can start small and gradually build up your investment over time. Here's a smart strategy to consider. Start with a $100 investment in a dividend ETF like CHD or VYM. Then, set up automatic monthly contributions, even if it's $25 or $50. Over time, those small amounts can add up, especially when you reinvest your dividends. It's like planting a tiny seed and watching it grow into a mighty oak tree. Remember, investing in dividend ETFs isn't about getting rich overnight. It's about building a steady stream of passive income over time. Think of it as creating your own personal money fountain. It might start as a trickle, but with patience and consistent investing, it can grow into a steady flow. Opening your first brokerage account. Easier than you think. You know that feeling when you're about to try something new? Maybe it's a bit of nervousness mixed with excitement. That's how many people feel when they're getting ready to open their first brokerage account. But here's the thing. It's actually a lot easier than you might think. In fact, it's probably even simpler than opening your first bank account was. Let's talk about what a brokerage account really is. Think of it as your personal gateway to the world of investing. It's where you'll buy and sell stocks, ETFs, and other investments. But don't worry, you don't need to be a Wall Street expert to get started. These days, online brokers have made the process super user-friendly, even for complete beginners. Now you might be wondering, isn't it complicated and expensive to open a brokerage account? That's a totally fair question, and it's one that stops a lot of people from getting started. But here's the good news. It's neither complicated nor expensive. In fact, many online brokers now offer accounts with no minimum balance requirements. That means you can start investing with whatever amount you're comfortable with, even if it's just $100. Let's walk through the process of opening an account with a popular online broker. First, you'll need to provide some basic personal information. We're talking about things like your name, address, date of birth, and social security number. You might also need to upload a photo ID, like your driver's license or passport. This is just to verify your identity and keep your account secure. Here's something that might surprise you. The whole process usually takes less than 30 minutes. That's right, in less time than it takes to watch your favorite TV show, you could be set up and ready to start investing. And the best part, you can do it all from your phone, or computer, right from the comfort of your couch. Now, let's address some common concerns that might be holding you back. Security is a big one, and it's totally understandable. After all, we're talking about your hard-earned money here. But here's the thing. Reputable online brokers take security very seriously. They use advanced measures like two-factor authentication and encryption to keep your personal and financial information safe. So while it's smart to be cautious, you can feel confident that your money and information are well protected. Another concern might be fees. In the past, trading stocks often came with hefty commission fees. But things have changed. Many brokers now offer commission-free trades on stocks and ETFs. That means more of your money goes directly into your investments rather than being eaten up by fees. As for ease of use, online brokers have really stepped up their game in recent years. They've designed their platforms and apps to be intuitive and user-friendly. Many even offer educational resources and tools to help you learn as you go. So even if you're completely new to investing, you'll find plenty of support to help you get started. Here's something else that might interest you. There's been a huge surge in young adults opening brokerage accounts recently. In fact, a report showed that the number of accounts opened by people aged 18 to 34 jumped by 50% in 2020. That's a lot of young people taking control of their financial futures. So what happens once you've opened your account? Well, you're ready to make your first investment with just a few clicks. It's that simple. You can start by buying a fraction of a share in an ETF, or you could invest in individual stocks if you're making your first investment, a step-by-step guide. Ready to turn that $100 into your first real investment? Here's the thing. Most new investors stumble right out of the gate. But with a few simple tips, you can avoid the common pitfalls and start your investing journey on the right foot. Let's talk about how to actually place your first order. You've got your account set up and your ETF picked out. Now it's time to make it official. But wait, before you click that buy button, there's something important you need to know. When you're buying a stock or ETF, you have two main options, market orders and limit orders. Think of a market order like going to a store and saying, "I'll take whatever's on the shelf at whatever price." You're agreeing to buy at the current market price, no questions asked. It's quick and simple, but there's a catch. The price can change in the seconds between when you place the order and when it's actually filled. A limit order, on the other hand, is like saying, I want this, but only if it costs X dollars or less. You set the maximum price you're willing to pay, and if the stock or ETF is available at that price or lower, your order will go through. If not, it won't. This can help you avoid overpaying, especially if the stock price is jumping around a lot. For your first investment, a limit order might be a smart move. It gives you more control and can help you stick to your budget. Plus, it's a good habit to get into as you continue your investing journey. Now, here's something really cool that a lot of new investors don't know about: fractional shares. Remember when we talked about buying into big-name companies? Well, with fractional shares, you don't have to buy a whole share of stock. You can invest as little as $1 in some cases. This is perfect when you're starting with $100 because it lets you spread that money across different investments, even if a single share would normally cost more than your entire starting budget. Let's walk through the process step by step. First, log into your brokerage account and find the ticker symbol for the ETF you want to buy. Let's say you've decided on SCHD, the Schwab US Dividend Equity ETF we talked about earlier. Type that into the search bar. Next, you'll see an option to buy. Click that, and you'll be taken to an order form. This is where you'll decide between a market order and a limit order. Remember, a limit order can help you avoid surprises. Now, enter the amount you want to invest. This is where fractional shares come in handy. Instead of entering a number of shares, you can usually just type in a dollar amount. So go ahead and put in $100 or whatever you're comfortable starting with. Before you hit that final submit button, take a deep breath. It's normal to feel a little nervous. You might be wondering, what if I'm making a mistake? What if the market crashes tomorrow? These are totally normal thoughts, but here's the thing. You've done your research. You're starting small and smart with a diversified ETF. You're not trying to time the market or make a quick buck. You're in this for the long haul, and that's exactly the right mindset. One more tip before you place that order. Consider starting with a small investment in a diversified ETF or a well-established company. This approach can help you get your feet wet while minimizing risk. As you gain more experience and confidence, you can always adjust your strategy. Okay. Moment of truth. Double-check all your information, take another deep breath, and hit that submit button. Congratulations, you've just made your first investment. You're officially an investor now. That wasn't so scary after all, was it? You've taken a big step towards financial freedom. But remember, this is just the beginning. Investing is a journey, not a one-time event. It's about consistent, smart decisions over time. Now that you've made your first investment, you might be wondering what's next. Should you just sit back and watch your money grow? Well, not exactly. There's more to building a successful portfolio than just making a single purchase. In the next section, we'll talk about how to grow your investment over time, including strategies for reinvesting dividends and adding to your portfolio regularly. We'll also discuss how to keep your emotions in check when the market gets bumpy, because it will. The power of dividend reinvestment, accelerating your growth. You've made your first investment. Great. But what if I told you there's a way to make your money work even harder for you? It's like getting free shares of your favorite stocks, and it's easier than you might think. Let's talk about the power of dividend reinvestment and how it can turbocharge your portfolio's growth. When you invest in dividend-paying stocks or ETFs, you have two choices every time you receive a dividend payment. You can either take the cash and spend it, or you can use that money to buy more shares of the same stock or ETF. This second option is called dividend reinvestment, and it's a game changer for long-term investors. Now you might be thinking, why would I want more shares instead of cash in my pocket? It's a fair question. After all, isn't the whole point of investing to make money? Well, here's the thing. By reinvesting your dividends, you're setting yourself up for even bigger payouts in the future. Let's break it down with a simple example. Imagine you own 10 shares of a stock that pays a dividend. When dividend time comes around, instead of taking the cash, you use it to buy one more share. Now you have 11 shares. The next time dividends are paid out, you'll earn money on all 11 shares instead of just the original 10. It might not seem like a big deal at first, but over time, this can lead to some serious growth in your portfolio. Think about it like a snowball rolling down a hill. As it rolls, it picks up more snow, getting bigger and bigger. That's exactly what happens with dividend reinvestment. Your reinvested dividends buy more shares, which then generate more dividends, which buy even more shares, and so on. This is what investing pros call the dividend snowball effect. Now, I know what you're thinking. That sounds great, but isn't it a hassle to manually reinvest my dividends every time? Here's some good news. Many brokers offer automatic dividend reinvestment for free. That means once you set it up, you don't have to do anything. Your broker will automatically use your dividend payments to buy more shares, keeping your snowball rolling without any extra effort from you. But wait, there's more. I know, I sound like a late-night infomercial, but I promise this is good stuff. Dividend reinvestment also takes advantage of a strategy called dollar-cost averaging. This means you're buying shares consistently over time, regardless of whether the market is up or down. When share prices are low, your reinvested dividends buy more shares. When prices are high, you buy fewer shares. Over time, this can help smooth out the effects of market volatility and potentially lower your average cost per share. Now let's talk about why this matters for long-term investors like you. When you reinvest your dividends, you're not just increasing the number of shares you own, you're also setting yourself up for potentially higher income and bigger gains down the road. Remember, more shares mean more dividends, which mean more shares, which mean, well, you get the picture. But don't just take my word for it. Investment experts consistently emphasize the importance of dividend reinvestment for long-term investors. They know that this strategy can significantly boost your returns over time, especially when combined with a diverse portfolio of quality dividend-paying stocks or ETFs. Now, I can almost hear you asking, this all sounds great, but how much of a difference does it really make? Well, the numbers might surprise you. Over decades, reinvested dividends can account for a significant portion of your total returns. In fact, for many long-term investors, reinvested dividends have been responsible for more than half of their total gains. Of course, like any investment strategy, dividend reinvestment isn't a magic bullet. It works best when you're investing in solid, reliable companies or ETFs that have a history of paying and ideally increasing their dividends over time. And as always, it's important to keep your portfolio diversified to manage risk. But here's the bottom line. If you're looking for a way to potentially accelerate your portfolio's growth without having to invest any extra money out of pocket, dividend reinvestment is a strategy worth considering. It's like planting a money tree that grows more money trees, and who wouldn't want that in their financial garden? From $100 to $1,000 monthly, a realistic timeline. We've been talking about planting our money tree, but let's get real for a moment. How long does it actually take to grow that tree into a whole forest of passive income? I know you're probably itching to see those dividend checks roll in, but building wealth takes time. So let's break down the timeline and see what it really takes to turn your $100 start into a $1,000 monthly dividend paycheck. First things first, to earn $1,000 in monthly dividends, you need a pretty hefty portfolio. We're talking about some serious cash invested. But don't let that scare you off. Remember, every big goal starts with a small step. So can you really get there starting with just $100? The short answer is yes, but it's going to take patience and consistency. Let's crunch some numbers. At a 3% dividend yield, which is pretty standard for many solid dividend-paying stocks and ETFs, you'd need about $400,000 invested to generate that $1,000 monthly income. I know. That sounds like a lot. But here's the thing, you don't need all that money right away. The key is to start small and keep adding to your investments over time. It's like building a snowman. You start with a tiny snowball, but as you roll it and add more snow, it gets bigger and bigger. Your investment portfolio works the same way, especially when you're reinvesting those dividends. So what does a realistic timeline look like? Well, it depends on how much you can contribute each month. If you're able to invest $100 every month, that's about the cost of a few fancy coffees a week, It might take anywhere from 30 to 40 years to reach that $400,000 goal. That might sound like a long time, but remember, you're building something that could potentially support you for the rest of your life. Now, I know what you're thinking. 40 years? I'll be old by then. But here's where it gets interesting. The timeline I just mentioned assumes a pretty conservative growth rate. In reality, your portfolio has the potential to grow faster, especially if you're investing in dividend growth stocks or ETFs. Let's talk about dividend growth for a second. Did you know that some popular dividend ETFs have shown average dividend growth rates of 10 to 15% annually? That's huge. It means that not only are you earning dividends, but those dividends are growing over time. This growth can seriously impact how quickly you reach your income goals. But wait, there's more. We haven't even factored in potential capital appreciation yet. As the companies you invest in grow and become more valuable, the price of their stocks can increase too. This means your initial investment could be worth a lot more down the line on top of the dividends you're earning. Now, I'm not saying you'll definitely see those kinds of returns. Investing always comes with risks, and past performance doesn't guarantee future results. But it does show that there's potential for your money to grow faster than you might think. Here's another cool thing to consider: the power of starting early. Let's say you invest $100 monthly in a diversified portfolio with a 7% annual return. In 30 years, you could potentially accumulate over $200,000. That's the magic of compound interest at work. But remember, the most important factor isn't how much you start with, it's how consistent you are. Regular contributions, even small ones, can make a huge difference over time. It's like training for a marathon. You don't start by running 26 miles on day one. You start with short runs and gradually build up your endurance. Investing works the same way. So while it might take 30 to 40 years to reach that $1,000 monthly dividend goal, if you're starting from scratch, the path is clear and achievable. And hey, who knows? If you're able to increase your contributions over time, or if you see better than average returns, you might get there even faster. Staying the course. Overcoming market volatility. All right, let's talk about the elephant in the room, market volatility. You've been diligently building your dividend portfolio, watching those numbers grow, and feeling pretty good about your financial future. But what happens when the market decides to throw a curveball? Don't worry, I've got your back. Here's the thing. Market ups and downs are as normal as breathing. It's just part of the investing journey. But I get it. Seeing your portfolio value drop can be scary, especially when you're just starting out. You might be thinking, what if I lose everything I've worked so hard for? Take a deep breath. We're going to tackle this fear head on. First, let's put things in perspective. When you're investing for the long haul, those day-to-day or even month-to-month fluctuations don't really matter. It's like watching a tree grow. You don't see much change day to day, but give it a few years and wow. The same goes for your investments. What matters is the big picture, not the daily squiggles on a chart. Now, here's some good news for dividend investors like you. Dividend-paying stocks tend to be the steady eddies of the market. They're like that friend who always shows up, rain or shine. During market downturns, these stocks often outperform their non-dividend-paying counterparts. Why? Because they provide a consistent income stream which acts like a cushion against volatility. Let me give you a real-world example. Remember the COVID-19 pandemic? It shook the markets like a snow globe. But guess what? Many dividend aristocrats, those companies that have increased their dividends for 25 consecutive years or more, kept right on paying and even increasing their dividends. Talk about financial strength. So how do you keep your cool when the market's acting like a toddler on a sugar rush? Here are some smart strategies. 1. Keep your eyes on the prize. Remember your long-term goals. That $1,000 monthly dividend income isn't going to happen overnight, so don't let short-term hiccups throw you off course. 2. Diversify, diversify, diversify. It's like not putting all your eggs in one basket. By spreading your investments across different sectors and companies, you're less likely to feel the full impact of a downturn in any one area. 3. Practice mindfulness. I know it sounds a bit woo-woo, but hear me out. Being aware of your emotions can help you avoid making rash decisions based on fear or panic. Take a step back, breathe, and remind yourself of your investment strategy. 4. Set predefined investment goals. Having clear objectives can help you stay focused when the market gets choppy. It's like having a roadmap. You might encounter some detours, but you know where you're heading. 5. Consider each dip as a sale. When the market drops, it's like everything's on discount. If you keep investing consistently, remember dollar cost averaging, you're actually buying more shares when prices are low. It's like getting more bang for your buck. Now let's talk about the power of staying the course. By remaining invested through the ups and downs, you're setting yourself up for some serious growth potential. It's all thanks to the magic of compounding and reinvested dividends. Each dividend payment you reinvest is like planting another seed in your money garden. Over time, those seeds grow into trees, which produce more seeds, and so on. Think about it this way. Market volatility can actually work in your favor if you keep a steady hand. When you consistently invest, regardless of market conditions, you're taking advantage of both the highs and the lows. It's like surfing. You ride the waves up and down, but ultimately, you're moving forward. Remember, investing is a marathon, not a sprint. It's about building wealth over time, not getting rich overnight. By staying invested through market turbulence, you're giving your money the best chance to grow and compound. It's like letting a snowball roll down a hill. The longer it rolls, the bigger it gets. Diversification. Don't put all your eggs in one basket. Now that we've talked about riding out market waves, let's explore how to make your financial ship even sturdier. What if I told you there's a way to potentially increase your returns while actually lowering your risk? It might sound too good to be true, but that's exactly what smart diversification can do for your portfolio. Think about your favorite restaurant. Sure, they might have an amazing signature dish, but would you want to eat there if that's all they served? Probably not. The same principle applies to your investments. By spreading your money across different types of assets, you're creating a financial menu that can satisfy your appetite for growth while also protecting you from potential downturns. Now you might be thinking, wait a minute, isn't my dividend ETF already diversified? That's a great question. While it's true that an ETF like SCHD or VYM gives you exposure to many different companies, it's still just one type of investment. It's like having a plate full of different vegetables. Nutritious, but not a complete meal. Let's break down the different levels of diversification. First, there's diversification within stocks. This is what your dividend ETF does. It spreads your investment across various companies and sectors. Then there's diversification across asset classes. This means including things like bonds, real estate, and international stocks alongside your dividend-paying investments. Finally, there's geographic diversification, which involves investing in markets outside your home country. Why does this matter? Well, different types of assets often behave differently in various economic conditions. When stocks are having a rough time, bonds might be doing well. If the US market is struggling, international markets might be thriving. By having a mix of investments, you're not putting all your financial eggs in one basket. Here's the key insight. Proper diversification can help reduce risk without sacrificing returns. It's like having a safety net for your investments. If one part of your portfolio takes a hit, the others can help cushion the fall. Let's talk about some other types of assets that can complement your dividend stocks. Bonds, for example, are generally less volatile than stocks and can provide steady income. They're like the calm, reliable friend in your investment group. Real estate, whether through REITs, real estate investment trusts, or property ownership, can offer both income and potential appreciation. And international stocks can give you exposure to fast-growing economies and companies that might not be available in your home market. By including a mix of these assets in your portfolio, you're creating a more resilient investment strategy. Think of it as building a financial house with different materials. If a storm comes along, like a market downturn, a house made of just one material might not hold up well. But a house built with a variety of strong materials is much more likely to weather the storm. This doesn't mean you need to go out and buy a bunch of different investments right away. Remember, we're on a journey here. As your portfolio grows, you can gradually add new types of investments. The important thing is to keep diversification in mind as you build your wealth over time. One of the best things about a well-diversified portfolio is that it can help you sleep better at night. Knowing that your investments aren't all tied to one type of asset or one market can bring peace of mind. It's like having a financial security blanket. And here's something really cool. Studies show that diversified portfolios tend to outperform non-diversified portfolios over the long term, especially when you look at risk-adjusted returns. That means you're potentially getting better results with less stress. Who wouldn't want that? As you continue on your investing journey, keep in mind that your ideal mix of investments might change over time. When you're younger and have a longer time horizon, you might lean more towards stocks for growth potential. As you get older and closer to needing your investment income, you might shift towards more bonds and other stable investments. The art of patience. Why checking your portfolio less is more. You know that feeling when you're waiting for a package to arrive? You keep checking the tracking number, refreshing the page every few minutes, hoping it'll magically appear on your doorstep. Well, investing can feel a lot like that, especially when you're just starting out. It's tempting to constantly peek at your portfolio, watching those numbers go up and down. But here's the thing, when it comes to investing, less really can be more. Let's talk about why checking your portfolio less frequently might actually be the secret sauce to better returns. It sounds counterintuitive, right? We live in a world of instant everything, where information is at our fingertips 24/7. But with investing, patience truly is a virtue. Think about it. When you're constantly checking your investments, you're more likely to react to every little market hiccup. One day your stocks are up and you're feeling on top of the world. The next day they're down, and suddenly you're wondering if you should sell everything and hide your money under your mattress. This emotional roller coaster can lead to some pretty questionable decisions. Here's where it gets interesting. Studies have shown that investors who check their portfolios less frequently tend to achieve better long-term returns. Why? Because they're less likely to make emotional decisions based on short-term market volatility. Instead, they stick to their investment strategies and let their money do its thing. It's like planting a seed and then digging it up every day to see if it's grown. Not only does this constant checking not help the plant grow any faster, but it might actually harm its growth. The same principle applies to your investments. But don't just take my word for it. Some of the most successful investors out there are known for their hands-off approach. They understand the power of compounding and long-term growth, and they don't let daily market movements distract them from their goals. Now, I know what you're thinking, but how am I supposed to know if my investments are doing well if I'm not checking them? Great question. The key is to find a balance. Instead of checking your portfolio daily or hourly, we've all been there, try setting a regular schedule for portfolio reviews. Many experts recommend quarterly or semi-annual check-ins. This way, you can still keep tabs on your investments and make necessary adjustments, but you're not getting caught up in the day-to-day noise. Here's another interesting tidbit. A study found that investors who frequently check their portfolios often experience higher levels of anxiety and stress. And let's be honest, who needs more stress in their life? This anxiety can lead to poor investment decisions and might even deter you from sticking to your investment strategy. By checking less often, you're not only potentially improving your returns, but you're also giving yourself some much-needed peace of mind. So how can you resist the urge to constantly monitor your investments? Here are a few strategies that might help. First, try removing investment apps from your phone's home screen. Out of sight, out of mind, right? If you have to actively search for the app, you're less likely to check it impulsively. Second, set specific times for portfolio reviews and stick to them. Maybe it's the first Saturday of every quarter or every 6 months on your half birthday. Whatever works for you, make it a scheduled event rather than a constant activity. Third, focus on your long-term goals. Remind yourself why you started investing in the first place. Was it for retirement? A down payment on a house? Your child's education? Keeping these big picture goals in mind can help you stay the course when short-term market fluctuations try to throw you off. Lastly, consider automating your investments. Set up regular contributions to your investment account and let them run on autopilot. This way, you're consistently investing without having to make active decisions or checks all the time. By checking your portfolio less frequently, you're more likely to stick to your long-term plan. You're giving your investments time to grow and compound without the interference of knee-jerk reactions to market movements. Think of it as letting your money work for you, hands-free. The payoff? Less stress, better sleep, and potentially better returns, all from doing less. It's like a financial win-win-win situation. You're not just saving time by not constantly checking your portfolio, you're potentially saving and making money too. Portfolio maintenance, keeping your investments in shape. Remember how we talked about the benefits of a hands-off approach to investing? Well, here's where it gets interesting. Even with a set-it-and-forget-it strategy, your portfolio needs a little TLC now and then. Think of it like tending to a garden. A bit of regular care can make all the difference. So, what exactly should you be doing to keep your investments in shape? And how often? Let's break it down. First up, let's talk about rebalancing. This is like giving your portfolio a tune-up. Over time, some investments might grow faster than others, throwing off your original mix. Rebalancing brings everything back into line with your goals. Here's the thing, you don't need to do this every day or even every month. Once a year is usually enough for most people. Some experts suggest doing it quarterly, but that's up to you. The important part is making it a regular habit. Now you might be wondering, does this rebalancing stuff really make a difference? Well, according to a study by Vanguard, portfolios that were rebalanced regularly actually performed better than those that weren't. Why? Because rebalancing forces you to sell high and buy low, a key principle of smart investing. But rebalancing is just one part of maintaining a healthy portfolio. Once a year, it's a good idea to take a step back and look at the big picture. Ask yourself, 1. Have my financial goals changed? 2. Has my risk tolerance shifted? 3. Are my investments still performing well compared to similar options? This annual check-in is your chance to make sure your money is still working hard for you. It's not about obsessing over every little change in the market. Instead, it's about making sure your investments still align with your long-term plans. When you're doing this review, don't forget about dividends. If you're investing for dividend income, which, if you're following along with our series, you probably are, take a close look at how your dividend-paying stocks or funds are doing. Are they consistently increasing their payouts? If not, it might be time to consider some changes. Now I know what you're thinking. This sounds like a lot of work. But here's the good news. With modern technology, it's easier than ever to keep tabs on your investments. Many brokers offer portfolio tracking tools that can give you a quick visual snapshot of your asset allocation and performance over time. These tools can make it super clear when you need to make adjustments. And remember, we're talking about spending just a few hours each year on this. That's it, a small investment of time for potentially big returns. Let's put this into perspective. Say you start with a balanced portfolio of 60% stocks and 40% bonds. After a year of strong stock market performance, your portfolio might shift to 70% stocks and 30% bonds. This might seem great, your stocks are doing well, but it also means you're taking on more risk than you originally planned. By rebalancing, you're not just maintaining your preferred asset mix, you're also managing your risk. Here's a simple process you can follow for your annual portfolio review. 1. Check your asset allocation. Has it drifted from your target? 2. Review the performance of individual investments against relevant benchmarks. 3. Consider any changes in your personal financial situation or goals. 4. Make necessary adjustments to realign with your investment strategy. 5. Look for opportunities to tax loss harvest if you're investing in a taxable account. This process doesn't have to be complicated. The key is to be consistent and stick to your long-term plan. Now, you might be wondering about the buy and hold strategy we've talked about before. Doesn't that mean you should just leave your investments alone? Well, not exactly. Even long-term investors shouldn't completely neglect their portfolios. The market changes, your life changes, and your portfolio might need to change too. The trick is finding the right balance between staying the course and making smart adjustments. Beyond ETFs, exploring individual dividend stocks. You've mastered the basics of dividend investing with ETFs, but now it's time to take your portfolio to the next level. Let's explore the world of individual dividend stocks. Don't worry, we're not talking about risky day trading here. Instead, we're going to learn how to spot quality companies that could become the backbone of your dividend portfolio for years to come. Think about it. While ETFs offer a great foundation, individual stocks can potentially provide higher yields and more growth potential. But here's the thing. With that potential comes the need for careful selection. You want to make sure you're picking stocks that will keep those dividends flowing, not leave you high and dry. So how do you separate the wheat from the chaff when it comes to dividend stocks? It all starts with understanding a few key metrics. First up is the payout ratio. This tells you how much of a company's earnings are being paid out as dividends. A good rule of thumb is to look for companies with a payout ratio of 60% or less. Why? Because it shows the company is keeping enough money to grow while still rewarding shareholders. Next, let's talk about the dividend growth rate. This is how fast a company has been increasing its dividends over time. A steady, consistent growth rate is a good sign that the company is committed to rewarding shareholders and has the financial strength to keep it up. But don't stop there. You'll also want to look at the company's overall financial health. This includes things like free cash flow, the money left over after the company pays for operations and investments, and the company's debt levels. A company drowning in debt might struggle to keep those dividend payments coming. Now, I know what you're thinking. This sounds like a lot of work. But here's the good news. You don't need to be a Wall Street analyst to do this research. There are plenty of free online tools that can help you dig into these numbers. Sites like Yahoo Finance or Morningstar can provide a wealth of information on dividend stocks. When you're researching, pay special attention to companies that have a history of consistently increasing their dividends. These are the real gems in the dividend world. In fact, there's a special group of companies known as dividend aristocrats that have increased their dividends for at least 25 consecutive years. These companies have proven they can keep the dividends flowing even during tough economic times. But remember, even with all this research, investing in individual stocks does come with more risk than ETFs. That's why it's smart to start slow. Maybe begin by adding 1 or 2 individual stocks to your ETF-based portfolio. As you get more comfortable with the process, you can gradually increase your individual stock holdings. Here's a pro tip. Spread your investments across different sectors. This way, if one sector takes a hit, your entire dividend income won't dry up. For example, you might have a mix of stocks from utilities, consumer goods, and healthcare sectors. Now, let's talk about a common pitfall to avoid: the high-yield trap. Sometimes you might see a stock with an incredibly high dividend yield and think you've struck gold. But be careful. An unusually high yield can sometimes be a red flag. It might mean the company is in trouble and the stock price has dropped, artificially inflating the yield. Always do your homework before jumping at a high yield. By adding carefully selected individual stocks to your portfolio, you're taking more control over your dividend income and growth potential. You have the power to choose companies that align with your financial goals and values. Plus, as you become more knowledgeable about these companies, you might find yourself more engaged with your investments, which can be pretty exciting. Managing risk, protecting your growing wealth. Think about it. As your investment portfolio grows, so does the need to protect it. It's like building a beautiful sandcastle on the beach. You want to enjoy it, but you also need to keep an eye on the incoming tide. Let's talk about how to play defense with your money without sacrificing potential gains. Here's the thing. Investing always comes with some level of risk. But understanding these risks is the first step in managing them. There are different types of risk to consider. Market risk is like the overall weather of the investment world. Sometimes it's sunny, sometimes it's stormy, and it affects everyone. Then there's company-specific risk, which is more like focusing on one particular sandcastle that might get washed away, even if the rest of the beach is fine. And don't forget about inflation risk, the sneaky tide that can slowly erode the value of your money over time. But here's where it gets interesting. Your attitude towards risk isn't set in stone. It's more like a mood that changes as you go through life. When you're younger, you might be more willing to take on risk because you have time on your side. It's like building your sandcastle closer to the water. Sure, it might get splashed, but you have plenty of time to rebuild if needed. As you get older and retirement comes into view, you might start feeling more protective of your nest egg. That's when you might want to move your sandcastle to higher ground, focusing more on preserving what you've built. Now let's talk about some smart money moves to manage risk. First up is diversification. It's like spreading your sandcastles across different parts of the beach. If one area gets hit by a wave, you still have others standing strong. This could mean investing in different types of companies, industries, or even countries. Another strategy is dollar cost averaging. This is where you invest a fixed amount regularly, regardless of what the market is doing. It's like steadily adding sand to your castle, whether the tide is in or out. When prices are low, you'll buy more shares, and when prices are high, you'll buy fewer. Over time, this can help smooth out the ups and downs of the market. Having an emergency fund is another key part of managing risk. It's like having a bucket of water nearby to protect your sandcastle from unexpected dry spells. With a financial cushion, you won't be forced to sell your investments at a bad time just to cover unexpected expenses. Here's a pro tip. Regularly reassess your risk tolerance and investment strategies. Life changes, and so should your approach to investing. Getting married, having kids, or nearing retirement are all good times to take a step back and make sure your investments still align with your goals and comfort level. Now you might be wondering, why bother with all this risk management stuff? Well, here's the payoff. By understanding and managing risk, you can invest with more confidence. It's like building your sandcastle with a solid foundation and protective walls. You'll be better prepared to weather the storms and stick to your long-term plan. Think about it this way. A well-managed portfolio can help you sleep better at night. You won't be lying awake worrying about every little market movement. Instead, you'll have the peace of mind that comes from knowing you've taken steps to protect your growing wealth. Supercharging your growth. Strategies for faster progress. You know that feeling when you're on a road trip and you suddenly realize there's a shortcut that could get you to your destination faster? That's exactly what we're going to explore now with your dividend investing journey. While we've talked about the importance of patience, there are some smart moves you can make to potentially speed up your progress towards that $1,000 monthly dividend goal. Let's start with a game changer: increasing your savings rate. This might sound simple, but it can have a dramatic impact on your long-term portfolio growth. Here's a little eye-opener for you. If you invest $250 per month at an 8% annual return, after 30 years, you could accumulate about $123,000. That's the power of consistent contributions over time. Now imagine what could happen if you bumped up those monthly contributions even a little bit. Think about it this way. Small increases in your monthly investments can make a big difference over time. It's like planting more seeds in your financial garden. The more you plant, the more potential for growth you have. And the best part? You're in control of this. You can decide to cut back on a few non-essential expenses and redirect that money into your investment account. Now let's talk about a concept that might sound a bit technical, but is actually pretty cool. Dividend growth investing. This strategy focuses on companies that not only pay dividends, but have a history of increasing those dividends over time. It's like having a job where you not only get paid, but also get regular raises. A study comparing dividend growth strategies to high-yield strategies showed that companies with a history of increasing dividends tend to perform better over the long term. Why? Well, these companies often have stronger fundamentals and a real commitment to returning value to their shareholders. It's like they're saying, hey, we're doing well, and we want you to benefit from our success too. But here's where it gets really interesting. Have you heard of the 8-43 rule? It's a neat illustration of how investments can grow exponentially over time. In the first 8 years, your investment grows steadily. Then, in the next 4 years, it doubles. And in the final 3 years, that's when you see significant growth. This really emphasizes the importance of patience and long-term commitment in investing. Now, I know what you might be thinking. High dividend yields sound great. I want more of those. But hold on a second. High yields can sometimes be a red flag. For example, a high yield might result from a significant drop in stock price, which could suggest the company is in financial trouble. It's like seeing a too good to be true sale at your favorite store. There might be a catch. So what's a smart investor to do? Well, one strategy is to look for companies that have a solid track record of not just paying dividends, but increasing them over time. These are often companies with strong financials and a real commitment to their shareholders. Let's talk about another way to potentially supercharge your dividend income: dividend reinvestment plans, or DRIPs. These plans allow you to automatically reinvest your dividends to purchase more shares. It's like planting the seeds from your financial garden right back into the soil. Over time, this strategy can significantly enhance your long-term growth potential. Now, for those of you who are feeling a bit more adventurous, there's another strategy to consider: using options. Specifically, a strategy called covered calls can provide additional income in dividend portfolios. This involves holding underlying assets while selling call options to generate income. But let me be clear, this is a more complex strategy that comes with its own set of risks. It's not for everyone, and it's definitely something you'd want to thoroughly research or discuss with a financial advisor before jumping in. Remember, the goal here isn't to take on unnecessary risk. It's about finding smart ways to potentially accelerate your progress without compromising the safety of your investments. It's like finding the balance between driving faster on your road trip and making sure you're still following the dividend limit and driving safely. You know that feeling when you find a hidden treasure and you're excited to show it off? Well, that's what we're about to explore with your dividend investments. But here's the twist. This treasure isn't about finding more money. It's about keeping more of what you've already earned. Let's talk about the often overlooked world of taxes and how understanding them can be like giving yourself a raise. When it comes to dividend income, the taxman always wants his share. But here's the thing. How much he takes depends on a few key factors. And guess what? You have more control over these factors than you might think. It's like playing a game where knowing the rules can help you score big. First, let's break down the two types of dividends: qualified and non-qualified. Qualified dividends are like the cool kids of the dividend world. They get special treatment from the tax authorities. Depending on your income level, you might pay 0%, 15%, or 20% on these dividends. Non-qualified dividends, on the other hand, are treated like your regular income. That means they could be taxed at a higher rate. So how do you get more of those qualified dividends? It's all about holding onto your investments for a certain period. Think of it like a loyalty program. The longer you stick around, the better the perks. In this case, holding on to US stocks or certain foreign stocks for a specific time can turn your dividends into the qualified kind. Now, let's talk about a smart money move that can really boost your dividend game: tax-advantaged accounts. Have you heard of Roth IRAs? They're like a special vault for your investments where your money can grow tax-free. Imagine planting a money tree in a magical garden where the taxman can't touch the fruit. That's basically what a Roth IRA does for your dividends. Here's where it gets really interesting. The way you place your investments in different accounts can make a big difference in how much tax you pay. It's like arranging furniture in your home. Put the right pieces in the right rooms, and suddenly everything works better. For dividend investors, this means thinking carefully about which investments go into your taxable accounts and which ones go into your tax-advantaged accounts. Let's look at an example. Say you have some dividend-paying stocks that you're excited about. If you put them in a regular taxable account, you'll have to share some of those dividends with the taxman every year. But if you put them in a Roth IRA instead, those dividends can grow and compound without Uncle Sam taking a bite. Over time, this difference can really add up. Now you might be wondering, is this really worth all the effort? Well, according to some smart folks who study this stuff, using tax-efficient investing strategies can lead to better long-term returns. It's like finding a shortcut on your financial journey. You're not changing the destination, just getting there faster and with more money in your pocket. But wait, there's more. If you're investing in a taxable account, there's another trick up your sleeve: municipal bond funds. These special funds invest in bonds issued by state and local governments. The cool thing about them? The interest they pay is often free from federal taxes and sometimes state and local taxes too. It's like getting a VIP pass to skip the tax line. Here's the bottom line. By understanding and optimizing for taxes, you're essentially giving yourself a raise. You're not earning more, but you're keeping more of what you earn. And isn't that what really counts? Remember, though, that tax laws can be complicated, and they change over time. It's always a good idea to chat with a tax professional about your specific situation. They can help you navigate the rules and make sure you're making the most of your investments without accidentally breaking any rules. Your dividend roadmap, charting your course to financial freedom. We've covered a lot of ground, from dividend basics to tax strategies. But here's the million-dollar question. How do you take all these pieces and build your own path to financial freedom? Let's create your personal dividend roadmap. Everyone's financial journey is unique, but the principles we've discussed apply to all. The key is to tailor these concepts to your specific situation and goals. Think about where you are now and where you want to be. Maybe you're starting with that $100 we talked about earlier, or perhaps you've already begun investing. Either way, it's time to chart your course. Let's start by setting realistic, personalized dividend income goals. Remember, this isn't about getting rich overnight. It's about building a steady stream of passive income over time. Think about what $1,000 monthly in dividends would mean for your life. Would it cover your rent, allow you to travel more, give you peace of mind? Whatever your motivation, keep it in mind as we plan. Now, let's create a sample 5-year plan for someone starting with $100. This isn't just a fantasy, it's a real roadmap you can follow. In the first year, focus on learning and consistency. Set up your brokerage account, choose a dividend ETF like SCHD or VYM, and commit to regular contributions. Even $25 or $50 a month can make a big difference over time. Year 2 is about increasing your knowledge and your contributions. Start researching individual dividend-paying companies. Look for those with a history of increasing dividends. These are often more reliable and can provide a steady income stream over time. As you learn more, consider adding 1 or 2 individual stocks to your ETF-based portfolio. In year 3, it's time to step up your game. If you haven't already, set up automatic dividend reinvestment. This is where the magic of compound interest really starts to shine. Also, think about increasing your monthly contributions if possible. Remember, even small increases can have a big impact over time. Year 4 is about diversification and growth. Look at spreading your investments across different sectors. Maybe add some international dividend-paying stocks or ETFs to your portfolio. This is also a good time to start setting specific dividend income targets. Maybe aim for $10 a month in dividends by the end of the year. In the final year of this 5-year plan, focus on fine-tuning your strategy. Review your portfolio's performance. Are you on track to meet your goals? If not, what adjustments can you make? This is also a great time to increase your financial knowledge even further. Consider reading books on dividend investing or attending investing workshops. Throughout this journey, it's crucial to remember that your plan should be flexible. Life happens, and your financial situation may change. Maybe you get a promotion and can invest more, or perhaps you face unexpected expenses and need to scale back for a while. That's okay. The key is to adjust your plan as needed, not abandon it entirely. This brings us to an important point. the significance of regular review and adjustment of your dividend investing strategy. As you progress through different life stages, your investment approach should evolve too. For instance, when you're younger, you might focus more on growth-oriented dividend stocks. As you near retirement, you may shift towards stable, income-generating investments to support your living expenses. Set aside time each year, maybe on your birthday or at the start of the new year, to review your dividend investing strategy. Look at your portfolio's performance, reassess your risk tolerance, and consider any big life changes on the horizon. Are you still on track to meet your goals? If not, what adjustments can you make? Remember, this isn't just about numbers on a spreadsheet. It's about creating the life you want. By creating and following a personalized dividend investing plan, you're taking control of your financial future. You're not just hoping for a better tomorrow, you're actively building it. Beyond the numbers, the life-changing impact of dividend investing. We've been crunching numbers and talking strategies, but now it's time to zoom out and look at the bigger picture. What if I told you that dividend investing isn't just about money in the bank, but about completely transforming your life? Let's explore how this simple investing strategy can open doors you never knew existed. Picture this: a young woman in her early 30s sipping coffee on a balcony overlooking a beautiful beach. She's not on vacation, this is her everyday life. How? She built a dividend portfolio that now generates enough passive income to fund her lifestyle. This isn't just a dream, it's a reality for many who've embraced dividend investing. Take Kara, for example. She started investing in dividends with just a few $100s a month. Fast forward a decade, and she's now living off her investments, completely independent of traditional employment. Kara's story isn't unique. More and more people are discovering the life-changing power of dividend investing. But it's not just about the money. There's something powerful about knowing you have a growing stream of passive income. It changes how you think about your future, your career, and even your day-to-day life. Imagine the confidence that comes with knowing you have a financial cushion that grows while you sleep. How might that change the decisions you make? Research shows that having multiple income streams like dividends can significantly boost your sense of financial security. This isn't just about feeling good, it can empower you to take risks and pursue opportunities you might otherwise avoid. Maybe you've always dreamed of starting your own business, but the fear of leaving a steady paycheck held you back. With a solid dividend portfolio, you might find the courage to finally take that leap. Let's talk about stress for a moment. Money worries are a leading cause of anxiety for many people. But here's the thing. Studies have shown that individuals who rely on passive income sources, including dividends, tend to report higher overall life satisfaction. It's not hard to see why. When you know you have a steady stream of income coming in, regardless of whether you work that day or not, it takes a huge weight off your shoulders. Now let's get real for a moment. Building a substantial dividend portfolio takes time and patience. It's not a get-rich-quick scheme, but that's part of what makes it so powerful. As you watch your dividends grow over time, you're not just building wealth, you're building confidence, discipline, and a new perspective on what's possible in your life. Think about the concept of the dividend snowball. As you reinvest your dividends, your income grows exponentially over time. This isn't just a financial strategy, it's a mindset. You're planting seeds today that will grow into a forest of opportunity tomorrow. And that sense of building something meaningful can be incredibly motivating and fulfilling. But it's not all about personal gain. Dividend investing can also align with your values and desire to make a positive impact. Many dividend-paying companies are leaders in their industries, often with strong records of social responsibility. By investing in these companies, you're not just growing your wealth, you're supporting businesses that align with your values. Let's consider another real-life example. Mike, a dividend investor in his 40s, shared his experience of building a portfolio that generates $1,000 a month in dividends. He emphasized that the journey wasn't just about the financial returns. It transformed his entire approach to financial independence. Mike found himself making smarter decisions in all areas of his life, from career choices to personal spending habits. The psychological benefits of dividend investing extend beyond just financial security. It's about gaining control over your life and future. When you know you have a growing stream of passive income, you're less likely to feel trapped in a job you hate or a situation that doesn't serve you. You have options, and that sense of freedom is priceless. Think about how this could change your relationships. Money stress is a leading cause of arguments in relationships. But what if you and your partner were building a dividend portfolio together, working towards shared financial goals? It could transform your conversations about money from sources of stress to exciting plans for the future. Here's something to consider. Dividend investing isn't just about retirement. It's about creating opportunities and flexibility throughout your life. Maybe it means being able to take a sabbatical to travel the world. Or perhaps it gives you the financial cushion to pursue further education or switch to a lower-paying but more fulfilling career. Remember, dividend investing is a tool for creating the life you want, not just accumulating money. It's about opening doors to possibilities you might not even imagine yet. As you embark on this journey, keep your eyes on the bigger picture. Yes, watch your dividends grow, but also pay attention to how it's changing your outlook, your confidence, and your sense of what's possible in your life. Let's talk about the power of that first $100 investment. Think about it. Every successful dividend investor started somewhere, just like you're doing now. Here's the thing. Your journey to financial freedom isn't about having a huge lump sum to start with. It's about taking that first step, no matter how small it might seem. According to expert predictions, dividend investing remains a key strategy for many millionaires. In fact, a study showed that 80% of millionaires have invested in dividend-paying stocks at some point. That's pretty encouraging, right? It shows that this approach has real potential for building long-term wealth. But remember, this isn't a get-rich-quick scheme. It's about consistency, patience, and smart money moves over time. As more people seek passive income streams, experts predict dividend investing will continue to play a vital role in personal finance. So why not join the trend? Your $100 start today,